Okay, let's get started on this mortgage market update. So what is going on in the market? The JP Morgan CEO said, brace yourself for an economic hurricane. The Fed's quantitative tightening or balance sheet reduction, which begins this month, combined with the war in Ukraine, which he believes could send oil prices to 150 to 175. And he believes the result of that would be an economic hurricane, or in other words, a recession, which we have been predicting for a while now. Home prices do tend to do well during recessions. A lot of the reason is because mortgage interest rates decrease during times of recession. ADP employment report showed that there were only 128,000 job creations in May, which is much less than expected, the expected 300,000 jobs. We are seeing a divergence among type of business with these job reductions. All job gains were from mid-sized to large employers, so that's greater than 50 employees. Small business had another big loss of 91,000 jobs after losing 120,000 jobs in April. So what we think is happening here is they can see what is happening quicker. They can be more nimble and make adjustments quicker. They are most likely having a tough time competing with the higher cost of inflation and the higher wage demands of workers. This should contribute to more layoffs and initial jobless claims, but we are not seeing that just yet. On to initial jobless claims. This measures the individuals filing for employment benefits for the first time, and this decreased by 11,000 to 200,000. While this is still a very low level of initial jobless claims, the 4-week moving average is at its highest level since February, so we are watching that. Continuing claims, which are those that continue to receive unemployment benefits after their initial claim. This number has decreased 34,000 to 1.3 million. This is the lowest number of continuing claims since December of 1969. The Bureau of Labor Statistics jobs report showed that there were 390,000 jobs created in May. This was stronger than the expectations of 320,000 jobs to be created. The unemployment rate is still very strong. By that, I mean low, but it did not decline as expected. Average hourly earnings were up 0.3% in May and are up 5.2% year over year, which is a decline from the previous report. Average weekly earnings were up by 0.3% and are up 4.3% year over year. These figures were a little beneath expectations. Some interesting information. Elon Musk said in a memo he wants to cut roughly 100,000 employees by 10%, and that's cutting about 10,000 employees from his workforce. He also said he has a super bad feeling about the economy. This follows Jamie Dimon's comments. Jamie Dimon is the CEO of JP Morgan, that he sees an economic hurricane coming. Several other companies are pausing hiring or planning layoffs, which should translate to more initial jobless claims in the coming month, which would lead to a higher unemployment rate. Our friend Barry Habib was able to have a conversation with Lacey Hunt, one of the brightest minds, best economists, and top bond market money managers in the world. Lacey said he believes the economy is in its current position due to a combination of bad monetary and fiscal policy, specifically spending too much and keeping monetary policy way too loose for way too long. Lacey agrees a recession is inevitable, but he thinks it won't come until the first quarter of 2023. He thinks inflation will start to abate by the fourth quarter of this year, and that interest rates will start to come down. He believes some of the supply chain issues will subdue and the Fed rate hikes will start to take hold. And he's talking about the quarter 4 of this year. He believes the 10-year Treasury will come back under 2% next year, which would be really good for mortgage rates. And he agrees that if the Fed pauses later this year, it may be a turning point for stock markets. If you hear the word Fed from the pause, that means that may be a good time for your stock portfolio. Speaking of the Fed begins their balance sheet reduction this month. There is some concern that less buying from the Fed and more supply will add pressure to mortgage-backed securities, causing mortgage rates to go higher. While this may be true, the impact should be muted due to less mortgage-backed security issuance, which is because we are doing less loans right now than we were before. That's all I have for this time's mortgage market update, and I will see you next time.